Let's bring in Dan Rasmussen. He's the founder and portfolio manager at Verdad Capital. Dan, really appreciate it. And it's important to set the stage here because in some ways, there were going to be problems or the sort of problems were going to come home to roost in private equity one way or the other. And we thought it was going to be from higher interest rates, that in many ways was going to be there. No one really saw, oh, by the way, the thing they invested in, private equity and credit over the past 15 years, overwhelmingly, is now at somewhat of a replacement risk due to AI. What do we know today about how many losses there are so far throughout the private equity and private credit spaces?
Right now, the losses are limited, Kelly. It's everyone anticipating that the losses are going to be much worse. And the reason that people are really pricing that in right now is that the big pitch, right? You got to remember that private credit is fundamentally lending to leveraged buyouts. They're lending to private equity deals. And in the past few years, probably about 40% of private equity went into software or software-related businesses. And so as the pitch of private credit, because remember, if you're lending to a software companies don't have assets, right? It's not like they have factories or trucks or something that you can lend against. In fact, many of them didn't have profits. They were investing their profits for growth. So broadly, what private credit was lending against was recurring revenue. And so what's happening now is that as software stocks have fallen, people are saying, well, gee, I don't know if that revenue is going to be recurring anymore. And you always told me, gee, we're lending this private credit. It's a risky business, but, there's a huge amount of private equity money in front of us. So the equity valuation is what supports the credit. Well, with software equities collapsing, right, people are saying, well, gee, I don't trust that equity story. I don't think that there's an equity cushion here. I think, in fact, there's going to be real losses here. And we're seeing a rise in PIK interest, right? So these firms aren't even paying off their loans. So I think the chickens are finally coming home to roost here, Kelly.
Can we put some big numbers on it? Private equity is, what, a $4 trillion industry, roughly speaking. Private credit is maybe $1.5 trillion. Am I in the ballpark here?
That's right.
Okay. So also we have to keep in mind both of these industries rose during the 2010s when interest rates were very low. It made borrowing very attractive. And to invest in software as a service business models gave you the golden egg was recurring revenue, like you're saying. Software as a service delivered that. So they've all kind of risen together. And now we have to go through the process of and I don't know if your firm is among, now people have to go really company by company, line by line, and figure this out. And it's going to take a long time to figure out where the biggest problems are.
Yeah, and I think you've got to understand just the most simple elements of this. Right, private credit emerged after the financial crisis because one of the lessons that the Federal Reserve and the regulators learned from the financial crisis and the banks learned is that this type of risky lending to LBOs, lending to really risky small businesses doesn't pay off because in a recession, you get huge default rates on this type of credit. So the regulators said to the banks, Morgan Stanley, Goldman Sachs, you got to move this off balance sheet. You can't have this on your balance sheet anymore. And private credit arose. They said, well, gee, the banks are missing this golden opportunity. The regulators are forcing them out of a great business. We're going to launch private credit to do exactly what blew up in 2008. We're going to lend all these small, risky companies, and we're going to do it better. And this went from being a small little backwater to being about equal size to the entire high-yield industry. So they've massively expanded, right? And predictably, when you lend at high rates, the only reason that you can lend at high interest rates is if the default risk is high. And if you're seeing this type of lending at the type of loan levels that private credit has been lending at, imply that this is like low single B type credit. And low single B type credit in a recession, about 30% of that defaults. So you could be looking at very significant losses across these portfolios in any type of credit stress environment.
And we talk about and show the biggest publicly traded ones. My guess is it's going to be the players that aren't even publicly traded, the ones that wouldn't even make it, where you're going to see even more problems. Because at least at the big guys, there's higher underwriting. They've been in it for longer. They probably have a lot of the better stuff before the last couple of years. What goes through your mind, Dan, when you hear people saying, our portfolio is only 6% in this, or our portfolio is only 7% in that?
Yeah. Well, the problem with private credit, right, they marketed illiquidity and opacity, and they said, gee, we're experts. We can trade these private market things, and they're better than the stuff you can access in public markets. Well, when things go wrong, people say, well, what do you own? And they've never heard of any of these companies they're lending to. And so it's too opaque. People are going to throw the baby out of the bathwater. And for a large number of these, they're right to do, right? For everyone like Ares maybe or HPS that are sort of the gold standard lenders, right? You go down and there's a million of these guys that have grown up in the last few years that really don't have great lending standards, that are basically lending to anyone who wants to do an LBO deal. And it was a race to the bottom.
Absolutely.
And so I think you're going to see hell to pay for those lenders. And by the way, the two other people that you can't forget are really problematic here: private equity, which is the equity that's in front of this debt, right? So for you to lose money on the loans, private equity has to lose a lot more. And then second, a lot of life insurers have put huge amounts of private credit on their books, and it's not going to end well for them.
Yeah.